welcome everybody. I think we're live here now. Very special day. Of course, thank you everybody for taking their time out of their very busy schedules to join us for this very important conversation that we're going to have with Lisa Moore. Had the pleasure of meeting Lisa three different times throughout our years in the industry in different capacities that she's been in. So we're very happy that she's here. We have an hour today, and I know there's lots of content that she's going to be going through. Obviously, kids are near and dear to our hearts, so I'm sure that you're going to have a lot of takeaways from some of the little nuggets that Lisa leaves you with today, and hopefully take that out to market and let's place some of these policies in and protect these families. So without further ado, Lisa, I think I'll pass it along to you, and let's get this thing started.
Excellent. Well, thank you so much, Dave. Definitely really excited to be here. I think this is the first presentation that I've had with this group. So thank you very much for having me. So we do have a pretty packed agenda. So without further ado, I'm just going to get started. Welcome to the Kids Start Why Life Insurance for Children presentation. So happy that you could join us today. Today, what we're going to talk about is basically this strategy and how it can be used to help provide an additional way for your clients to transfer their wealth from one generation to another, and what the benefits are for life insurance on children. So this is the disclaimer. Like I said, we have a full agenda today, but I definitely have to start off with some housekeeping. This is our disclaimer, just to let you know that the presentation reflects the views of Empire Life as of today's date. I'll leave it up here so you guys can read it word for word. Just kidding, as long as we have a basic idea of this, definitely we can get going. So like I said, for today's agenda, we have a pretty packed agenda here. First off, we're going to look at, understanding the opportunity you have to work with your clients on an intergenerational wealth transfer. Second, we'll walk through some of the specific examples as to why life insurance for children helps provide them with solid financial foundations in the future. Third, we'll go and review the actual Kids Start strategy that Empire Life has put together and how it can be effective for your clients that are looking for the ability to transfer wealth between generations. Fourth, we'll walk through a case study on how the Kids Start strategy can be implemented and the benefits of a 20-pay participating whole life policy. And lastly, we can walk through another case study looking at, again, the Kids Start strategy and how it can be implemented and what the benefits of an 8-pay participating whole life policy can provide. So let's just take a look at the opportunity. So the Kids Start strategy provides clients the opportunity to utilize a participating permanent life insurance policy on a child that can become paid up prior to the child becoming an adult. This strategy provides a tax-efficient way to transfer wealth from one generation to the next, and it also provides the child with important insurance protection that can last them a lifetime. Before we dig further into the Kids Start strategy, let's first take a look at some of the opportunities and why clients may be interested in this option. So I'm sure everybody's probably seen this slide recently, but currently in Canada, we are in the middle of the single largest transfer of wealth in history. Approximately $1 trillion in personal wealth will be transferred to the future generation between 2016 and 2026. This is a huge and unique opportunity to be met with, to speak to your clients and actually present them with a solution where they could utilize this and transfer that wealth to another generation on a tax-free basis. So when we're taking a look at our blocks of business, when you're talking to your clients, definitely would like you to kind of think about it and think, do you have clients who are looking to, provide a head start in life for their children or even their grandchildren, nieces or nephews? Do they have, the need to transfer wealth to a future generation in a tax efficient way? Understanding how this Kid Start strategy works and how it can provide additional flexibility to clients is one of the many reasons why you should be considering it. There are clients looking for ways to deaccumulate their assets and pass them on to future generation. And this strategy actually gives them the opportunity to do so in a very straightforward and easy to understand manner. By taking advantage of the Kid Start strategy, your clients are able to capitalize on using life insurance as an asset class and provide them the opportunity to pass on wealth generated into future generations. And they can basically lock their children or grandchildren's insurability in at that time as well. So there are many reasons to consider taking a look at the Kid Start strategy, including redistributing taxable investments into another asset class and diversifying their investment portfolios. All cash value growth within a policy is tax deferred. This is providing an opportunity to grow wealth. The life insurance provides a tax efficient transfer of wealth to the next generation, since there's no tax payable when the ownership of the policy is actually transferred from parent or grandparent to the child. So again, 3 really good reasons why to take a look at the opportunity. Now that we've kind of reviewed some of the reasons to consider it, let's explore what the actual Kid Start strategy could mean to your clients. So again, we can take a look at some of the many benefits of using the Kid Start strategy for your clients. So some of these benefits, again, are going to include cost-effective permanent life insurance for the child or the grandchild. Again, looking at this, it's a tremendously inexpensive way to get your child started. The policy can become paid up in as little as 8 years with Empire Life. So we have our 8, our 10, and our 20-year options for our participating whole life coverages. All the cash value growth is tax deferred. So basically that means there's no tax implications as long as the policy grows in value. And then when the policy ownership is transferred to the child or the grandchild at the age of majority or later, it's transferred tax-free with no negative consequences. So just to kind of reiterate on that, the reason the transfer of ownership is considered tax-free is due to subsection 148(8) of the Insurance Act. Basically, this section indicates that as long as there's no consideration paid on the transfer, the ownership and all of the value within the policy can be transferred to the child or the grandchild tax-free. For the policy owner transferring the ownership of the policy, the proceeds of the disposition are deemed equal to the policy's ACB. For the person receiving the policy, the transfer of ownership of the policy is acquired at cost equal to those proceeds. So why life insurance for children? In addition to intergenerational wealth transfers, there's many different reasons to consider life insurance on a child. So we can take a look here at 3 different reasons why life insurance for children helps set them up in the future for financial success. So first of all, it's cost effective. Again, putting coverage on a child versus coverage on an adult or a young adult, it's definitely going to be a lot more cost effective. Secondly, it's going to provide them with access to cash throughout their lifetime. And third, it's going to lock in the child's insurability at a young age. So let's take a look at an example on how these 3 reasons can basically work. So number 1, because the premiums are cost effective. So purchasing a participating whole life insurance policy on a child can be significantly less expensive than waiting until they are an adult. So if we take a look at this example, we're comparing purchasing an estate max 20-pay policy on a female non-smoker for $100,000 at a variety of different ages. So if you take a look at the chart, you can see purchasing a policy at age 0 compared to, let's say, age 45 is about a third of the cost. When you're looking at the total cost of the policy ownership, the difference is actually quite substantial. So if you can see here, purchasing it at age 0 versus age 45 is going to save approximately $36,000. There's definitely other reasons that we'll take a look at as to why life insurance for children makes sense. But the difference in cost can be substantial between buying when a child is young than waiting until they're adults. So let's take a look and use this same example for a female age 0, and we can go through a couple of other examples in the next following slides. So again, like I said, we're using that same example for a female age 0, and basically purchasing a participating whole life policy and looking at how the insurance policy provides access to cash value throughout the child's lifetime, and how you can utilize it through different opportunities. So as you can see here, the total cash surrender value within a policy continuously grows through a combination of the guaranteed cash values and non-guaranteed cash value that is provided by the annual dividends. This is going to provide the child with opportunities to utilize that cash value at specific points within their lifetime whenever they need it. When purchasing a policy on a child with the purpose of transferring wealth from one generation to another, this allows the cash value to grow in the policy, tax deferred, and then on the transfer of ownership to the child or grandchild, no tax is payable. The only time tax may be payable is if the child then tries to take a loan or withdraw from the policy. In this scenario, the tax would be payable by the child since they would be the owner at that time of the policy. This is advantageous because often the child is in a much lower tax bracket than the original owner at the time. So just to take note, accessing the cash value through a policy loan or withdrawal may have tax implications and or a loss of insurance coverage throughout the policy. So again, this is a great little slide just kind of showing access to different points at different points of their lifestyle or lifespan and what you could utilize the cash value for. So thirdly, locking in the insurability while the child is young and healthy. Using the same example here, we've been looking at once the insurance policy has been issued on a child, it will continue to grow each year through the annual dividend. In addition to purchasing this policy on a child when they're young and healthy, it guarantees that they will have insurance as an adult. This is really important factor to consider because, as we all know, the life insurance can only be purchased by someone who's healthy and young and healthy enough, to go through the underwriting and actually qualify to have the insurance. So also, as an additional benefit, it is possible to add benefits to the policy. For example, a guaranteed insurability benefit. You can add this to the policy as well, which will basically guarantee that at specific option dates in the future, the child will have the ability to continue to purchase additional life insurance without having to provide any medical evidence at that time. Again, purchasing the policy on a child at such a young age, your client is guaranteeing that regardless of any future health changes, that child will always have life insurance coverage put in place. When they're looking at a policy purchased on a newborn, you can see how the insurance amount continues to grow each year through the annual dividend. So again, this is really cool, just kind of taking a look at how the policy grows. At the bottom here, you can see at age 20 in this particular situation, the policy is fully paid up. And basically, it's going to continue to grow and be in place for that person or that child for their lifetime, and they can choose to use it how they wish. So now that we understand the opportunity and why life insurance on a child makes sense, let's now explore how the Kids Start strategy works and how it could benefit your clients. So the Kids Start strategy from Empire Life can be set up in 3 easy steps. So basically, step number 1 would be a grandparent or parent purchases a limited pay Empire Life participating whole life insurance policy on the life of their grandchild or child. Working with their advisor, clients can determine the annual premium that they want to pay and the right amount of insurance to purchase that will provide the long-term growth of the death benefit and cash surrender value. Depending on the needs of the client, often a shorter pay period works well for this strategy. So again, such as using an 8-pay or a 10-pay participating whole life insurance policy. Step number 2, they would transfer the ownership of the policy to the grandchild or the child at either the age of majority or whenever they feel best. As I mentioned previously, when the transfer of ownership happens, there's no tax payable on the transfer. So this means even if the cash surrender value is worth more than the total premiums paid at the time of transfer, there would be no tax payable on the transfer of the policy to the grandchild or child. Step number 3, the grandchild or the child becomes the owner, continues to be the life insured on the policy. The policy is fully paid up by the time of the transfer in most cases, and the policy continues to grow both in cash surrender value and in the death benefit throughout the child's life and into adulthood. So very basic kind of concept with 3 easy steps. So let's explore further into the benefits that the Kids Start strategy can offer your clients in addition to the participating permanent life insurance policy. Locking in the insurability of a child and setting them up for future financial success. It also offers the following. So it will offer tax-free transfer of wealth from one generation to the next. All of the insurance premiums are based on the age of the child. So this is really important because it allows your clients to purchase participating whole life insurance that is very much cost effective. With 3 limited pay options, so with Empire, we have our 8, our 10, and our 20 years. You can work with your clients to determine what that right payment structure is. Having a policy that is paid up provides a paid up asset to the children where they have the life insurance and access to the cash surrender value without having to make any payments themselves. It was fully funded prior to the transfer of ownership. So again, they can basically set it and forget it. Also, we're going to take a look and make sure that every year the policy qualifies for that annual dividend, which will basically continue to grow that total death benefit and the total cash surrender value. Prior to the transfer of ownership happening, if for any reason your client needs to access the money within the insurance policy, they're still the owner and they can access that money if they needed it. So again, it's providing additional flexibility to the clients who are interested in, again, that intergenerational wealth transfer, but might be worried that they don't have access to the money in case of emergency or if their financial situations change in the future. So again, the flexibility is there. They'll still have access to their money if they needed it. So now that we know the benefits of the strategy and how you identify which clients that it would actually work best for, typically the Kids Start intergenerational wealth transfer strategy is going to work best for clients over the age of 60. Clients who have retired or are near retirement and have investments that they do not need to access during their lifetime. And they're interested in locking in the insurability of their grandchildren with the gift of life insurance in mind as well. In addition, this strategy could be effective if they have several of their investments in non-registered investments and are looking for a tax efficient way to grow and transfer their wealth to future generations. They're interested in leaving a legacy. It's important to them to ensure that their grandchildren are set up for future financial success. They understand the importance of purchasing a participating life insurance policy, and they see the value that it could provide to their grandchildren. They're looking for a solution that will provide them with flexibility with regards to how and when the money can be used. Unlike an RESP where it's designated for education savings, the money transferred through a life insurance policy can be used however the client wishes it to be used. So again, we've gone through how to set the strategy up and what the benefits are and who the ideal client is. It's still important to understand once the ownership is transferred, how the grandchildren will be able to actually access the money throughout their lifetime. So let's take a look and explore how to access the total cash value of a life insurance policy and still keep it in force. So again, these slides are pretty straightforward and easy to understand, but we can first off basically take a look at how they can utilize the cash value. Number one, they could take a policy loan to access the total cash value. So on a policy loan, the maximum loan available is generally approximately 74% of the total cash surrender value. Basically, it will be up to the client to decide if they want to pay for the loan interest, how they want to pay the loan interest back, or they can let it capitalize on the loan and do it that way. So any outstanding policy loan plus the interest will be deducted from the death benefit at the same time of the death, or the cash surrender value at the same time the policy is surrendered. Tax would only be payable if the policy loan exceeds the ACB of the policy. Next, they could take a policy withdrawal to access some of the cash value. On a policy withdrawal, the maximum amount available is the total non-guaranteed cash value. The non-guaranteed cash value can be defined as the cash value that is provided through the annual dividend. If the client chooses to take a policy withdrawal, it will reduce the death benefit because the paid up additions purchased within the dividend are being surrendered. Once a withdrawal is processed, it is not possible to repay the money back into the policy. So tax would only be payable if the total cash surrender value exceeds the ACB. For partial withdrawals of the ACB, it will be prorated based on the amount of the withdrawal. Lastly, the client could also collaterally assign their policy to the bank or a lending an institution to secure a loan. Typically between 75 to 9% of the total cash surrender value is available to be loaned against, depending on the bank or the lending institution that you're dealing with. As this is a third-party loan and not actually being withdrawn from the policy, any outstanding loan interest and principal would be deducted from the death benefit or the cash surrender value option surrender. As the policy is collaterally assigned to a lending institution, on death or surrender, the loan is first paid back to the lending institution, and then the rest of the funds are dispersed to the named beneficiaries. If the insurance policy is individually owned, which it would be with a Kids Start program, the loan is provided by the bank or the lending institution tax-free. So now that we've kind of taken a look and we understand the different ways that the total cash surrender value can be accessed through the child's lifetime, let's take a look at an actual case study on how the Kids Start strategy could be used throughout the child's lifetime. So let's take a look at how the Empire Life Estate Max can meet the needs of clients looking to purchase life insurance on their children or grandchildren. So let's meet Aiden and April, both 58 years old, and as a part of their retirement, they're planning with their advisor. April and Aiden shared that they have a new granddaughter, Emily, and how they couldn't be more excited. Having used life insurance as a part of their retirement plan, their advisor lets them know all of the benefits of life insurance for children and showed them how, for under $50 a month, they could help secure their new grandchild's financial future. Having just reviewed their retirement plan with their advisor, not only showed them the insurance policy, but it also showed them where their financial plan could reallocate some money to help cover costs of the policy, and how if they had additional grandchildren, they could do the same for them in the future too. So their advisor showed them how an Empire Life Estate Max 20-pay insurance policy could be a good option for their granddaughter Emily. With the insurance policy only being payable for 20 years, they would be able to provide their granddaughter with a paid up asset when she is 20 years old. The advisor presented the following solution for April and Aiden. $125,000 Estate Max participating policy. The policy, again, is only payable for 20 years and then becomes fully paid up. And the monthly premium on this policy is only about $46 a month. They utilized the enhanced dividend option, and the total premiums paid over the lifetime is $11,138. The contingent owner of this policy will be Anna, April and Aiden's daughter, who is Emily's mother. So if we take a look at some of the benefits, at age 20, the ownership of the policy can be transferred to Emily at any time since she's above the age of majority. This transfer happens tax-free, and April and Aiden can choose when the right time is for them to transfer the actual policy to Emily. Since the policy was purchased when she was a baby, the policy is now paid up and will continue to grow regardless of the current future of Emily's health. Total cash surrender value of $8,980 can be used through a policy loan to help potentially cover a year of post-secondary education, or she can continue to let that cash value grow and accumulate for future needs. Once the ownership is transferred, if Emily needed access to money to help her with post-secondary education, if taxable, it would be taxed to her. This is advantageous because at the age of 20, she is most likely in a much lower tax bracket than her grandparents, April and Aiden. If we take a look at the benefits, if she were to keep the policy until age 65, her insurance is now over $275,000, and the cash surrender value is now over $135,000. Emily is happy to see that This paid up asset has continued to grow and provide her with value throughout her life. The total cash surrender value has exceeded the total premiums paid by age 24, which is amazing. As she started to plan her own legacy, $135,000 of cash surrender value is a great contingency fund if she starts to outlive her assets in retirement and if she ever needed to access it. The life insurance of just over $278,000 provides her with the opportunity to leave a legacy to her own kids or grandkids. And this is, again, a tax-free benefit that can be used to transfer her wealth from one generation to another. So having seen the value that this policy has provided to her, now it would be the time that Emily would actually look at this strategy to purchase life insurance policies on her own grandchildren. At life expectancy or age 85, there is over $470,000 of life insurance. Emily could choose to leave this as a tax-free legacy to her children or grandchildren. She could choose to also leave all of it or part of it to her favorite charity. If she chose to leave the money to, let's say, her favorite charity, she would receive a tax receipt for the full donation amount, potentially reducing tax she may have payable on her estate when she passes away. Having a total cash value of over $365,000 provides Emily with the same security, knowing that if she has an additional source of money available, if she were to outlive her retirement savings. The single gift from April and Aiden has now left a legacy not only for Emily, but for her children and grandchildren as well. This is providing a tax-efficient way to transfer wealth to multiple generations. So that's really a way to kind of take a look at the benefits of using the Empire Life 20-pay strategy. So let's take a look at how our Empire Life 20-pay Estate Max actually compares with our competitors in the industry. So let's take a look at a comparison here. So in this slide, we're just highlighting how Empire Life compares to two other insurance companies. So we have Company A and Company B. All three companies are illustrating the exact same scenario. So we have a female, age 0, all estate style par products. They're all 20-pay options, and they're all using an enhanced dividend option with the lifetime guarantee on the enhancement. They are all compared using the same monthly premium of $46.41. So again, this is really great. I'm really happy to share this with you guys to take a look at how competitive we are when you're looking at the total death benefit on the current dividend scale. You can see here that Empire Life offers the most insurance amount at issue and maintains that throughout the life of the policy. Really, really exciting news here. Again, at issue, Empire Life offers significantly more insurance upfront than the other competitors. At $125,000, we are 151% higher than Company A and 59% higher than Company B. Really, really excited to see these numbers. Looking at ages 65 and 85, Empire Life is 32% higher at age 65 than the next closest competitor and 23% higher at age 85 than the next closest competitor. Again, using the same parameters, but looking at current scale -1, Empire Life still offers the most insurance amount at issue and maintains that lead throughout the life of the policy. So again, if we take a look at ages 65 and 85, Empire Life is 42% higher at age 65 to the next competitor and 34% higher at age 85 than the next closest competitor. So if we kind of switch gears here and take a look at the cash surrender value, using those same parameters, a female age 0, estate max products for a 20-year premium structure, Empire Life offers the most cash surrender value on the current dividend scale and maintains that lead throughout the lifetime of the policy. So very excited about that. Again, when we're looking at ages 65 and 85, Empire Life is still 22% higher at age 65 and 21% higher at age 80 the next closest competitor. So again, just taking a look at the same information at the current dividend -1 using the same parameters. Again, Empire is looking fantastic. We still maintain that lead throughout the lifetime of the policy at ages 65 and 85. Again, we're looking at 29% higher at age 65 and 32% higher at age 85. So again, this is fantastic news, and these numbers are based on the new updates that we've just released recently. So if you are excited and you haven't heard anything about that, please make sure to reach out to your Empire Life wholesaler. We'd be more than happy to go over the new enhancements that we have made to our PAR products, because as you can see, we are now very, very competitive in this space. So let's take a look at, again, using the power of an 8-pay strategy. So this is a completely different case study. So this one regards Ken and Kyla. They're both 62 years old, and they're interested in leaving a legacy that can be passed down to their grandchild, but they don't know which option to consider. To determine the best way to do this, they've booked a meeting with their advisor to talk through all of the different options. So meeting with their advisor, it was determined that they have more than enough money saved to cover off all expenses throughout the rest of their life. A lot of their money is saved in RSPs and TFSAs, and there's no additional room available in either for additional contributions for both of them. So in addition to the value of their estate that will be left to their children, there is about $100,000 of non-registered investment that they would like to gift to their grandson, Kai, who is 4 years old. So after reviewing all of the information, Ken and Kyla's advisor determined that an Empire Life Optimax 8-pay insurance policy could be a good option for this intergenerational wealth transfer. And with the insurance only being payable for 8 short years, it would not be something that they would need to continue to fund throughout their retirement. The advisor presented the following solution to Ken and Kyla. So basically what they provided here in this case was a $655,000 Optimax Wealth participating permanent life insurance policy. They set it up as an 8-pay, so the policy is only going to be paid up for 8 years, then becomes fully paid up and guaranteed. The annual premium on the policy would be $12,500. They selected the paid up additions dividend option. The total amount of the premiums paid would be the $100,000. And the contingent owner would be Carlos, who is Ken and Kyla's son and Kai's father. So at age 20, the ownership of the policy can be transferred to Kai tax-free. Since the policy was purchased when Kai was a child, the paid-up life insurance will continue to grow regardless of his current or future health. The total cash surrender value has grown significantly and can be used through a policy loan or withdrawal to help cover post-secondary education, or they can continue to let it grow. If Kai needs access to the money to help with his post-secondary education, if taxable, it would be taxed at his tax bracket and not his grandparents. So again, this is advantageous since at age 20, Kai is most likely in a much lower tax bracket than Ken and Kyla would be. So if we take a look at age 65, what we would be looking at with respect to this insurance coverage and that $100,000 original investment, Kai's insurance is now over $3 million. And he's very comfortable knowing that if he needs to use all of his savings for retirement income, there is a large amount available to help fund a legacy that he'd like to leave behind. With over $1.6 million available in cash value, Kai has several options that he can consider to generate additional income streams in retirement. He could switch the dividend options from paid up additions to cash payment. Again, just to note, if he did make this change, the dividend would be sent to him each year and would no longer be used to purchase paid up additions. So there might be tax implications there. Since their policy is individually owned, he could collaterally assign the policy to structure a tax-free loan from the bank or a lending institution to help supplement his retirement income in the future. Again, interest may apply, and the outstanding loan interest would be deducted from the death benefit at the time of death or cash surrender value if they choose to surrender the policy. So again, Kai has seen the value that this gift has provided to him. So he's now decided to purchase policies on his grandchildren, helping them to secure their financial futures as well. If we take a look at age 85, there is over $5.4 million in life insurance. Kai knows his legacy goals are now more than met. Having the total cash value available to him relieves the stress that he had wondering if he would outlive his savings. This single gift from Ken and Kyla has now left a legacy not only for Kai, but for his children and grandchildren, as well as providing a tax-efficient way to transfer wealth to multiple generations. So if we take a look and change focus and look at how our OptiMax Wealth 8-pay whole life policy compares to the other options available, for example, our 10-pay and 20-pay versions of this product using the same parameters as the case study, I just wanted to kind of say what we are highlighting here is basically the power of the 8-pay payment option. The 8-pay, the 10-pay, and the 20-pay versions of the product would have met all of the objectives for Ken and Kyla, but just wanted to highlight how great the actual 8-pay highlights and how it offered a higher initial death benefit, higher death benefit throughout the whole lifetime of the policy. So again, using the same parameters here, we have a male, 4 years old, an OptiMax Wealth paid up additions with a total premium of $100,000. So again, the screen is a little bit small, but you can see here the benefits of using that 8-pay are absolutely tremendous, especially if you're looking for that quick pay option and you do have clients that have capital that can be used in this situation. If we look at the death benefit on, let's say, the current dividend scale, -1, you can see that the 8-pay option continued to offer the most long-term value and still provides a good opportunity to grow the death benefit over the long term. In addition, it is important to look at the -1 scenario because it highlights that even if the dividend were to drop, there is still significant value that this strategy can provide to your clients. If we switch gears a little bit here and look at the actual total cash surrender value on the current dividend scale, you can see that the 8-pay offers the highest cash surrender value throughout the life of the product. I specifically highlighted here age 12 as this is the date that the 8-pay policy would officially be paid up and no future premium payments would be paid into the policy. So even with no additional payments, the cash value continues to grow and be the highest compared to the other payment option throughout the life of the policy. So again, same scenario, just looking at the current dividend -1 for the total cash surrender value, you'll notice that even with the alternative scenario, that this strategy still provides significant value Again, looking at age 12, which is again when the policy is paid up, the difference in cash value is only about $750 between the current dividend scale and the alternative -1 scale. In situations where your clients have additional capital to fund insurance in a shorter period of time, it would provide your clients with the most value long-term, as the death benefit and the cash value grow higher than the other payment options. So definitely, if you are looking at this, it's worthwhile to take a look at all of the different options. So for both of the case studies we reviewed, clients could have chosen to pay all of the premiums in a single lump sum or a single payment option. So if you had owners or payers, if they wanted to have the full amount available, they could have purchased a term certain annuity or made a single deposit into a side account. So again, if you did have clients with a deposit that they wanted to use in a one-pay strategy, there are ways that we can look at it and figure out how to do that for your clients. And again, if you wanted to discuss that further, please feel free to reach out to your account executives and they'd be more than happy to discuss different options available for you. So we have a number of different marketing material available. Specifically, there's two pieces that highlight this strategy really, really well. The first is our advisor guide, where you can learn more about the strategy and how it works and how it benefits your clients. Second is a really great video that you can share with your clients. The video highlights how the strategy works in a client-friendly format. It's easily shareable on your social medias and your platforms. And again, this is all available on our website, or we can always send that out to you via your account executive. So again, if you visit the empirelife.ca website, just hit /Kidsstart. And again, it will take you to a specific landing page for the Kidsstart platforms. In addition to the support that you receive from your account executives, you also have access to our tax, retirement, and estate planning team, also known as our TREPS team. So you have if you have a complex or a large case or need some support, our team is available to you. So Peter, Diana, and Alex are all there and would be more than happy to assist you with any questions or support that you might need. If you wanted to learn more about the team, there is a QR code there. Please feel free to scan that, and it can take you to their landing page and how they can assist. If you had a specific question or something that you would like to discuss with this team, again, please feel free to reach out to your account executive, and we would be more than happy to connect you with the team and have a meeting to discuss any situations. So with that, it concludes the presentation that I have. I would definitely like to thank you for attending, and I hope you were able to learn something or something new with the information that we've shared. Hopefully the Kidsstart strategy could work with you, with your clients, and hopefully at least you've taken something away and you're able to perhaps discuss this with your clients and have somebody in mind to kind of present this to.
Lisa, do you have time for a few questions here? Because I see one here is for the smoker. Is the rate for smoker or non-smoker for child?
Yeah, so basically with life insurance policies, most of them, it's a blended rate. So they're always going to be showed as a smoker. They're not a smoker, but there's always the opportunity to remove that smoker rating if you wanted to at age 18. Again, it's a blended rate. It's the same across the board. I know it's not something that you always want to see, but it's just the way that we have it all set up.
Yeah, yeah. Another one just came in here. If the parents die before transferring the ownership to the kids, what happens?
So that's why we set up a contingent beneficiary. So normally if it's a grandchild, they would set up the mom or the dad of the policy, and then it would be set up that way.
Right. Okay. Which I think is, then I'm scrolling up to the top of the list there, and someone else, brought that up in terms of, is it tax-free for transfer to contingent owners? Suppose the grandparent was taking a life insurance policy on the grandkids and they pass us away, the setup. Yeah. Okay. So similar in terms of how that would flow. Great. Do we have any more questions that are coming through? I think that's it, man. You must have. I think you've covered everything here. So you've left everybody speechless. So
either that or I put them to sleep.
Oh, we got another one here. So how does Empire view or treat a child applicant on the autistic spectrum? Great question.
So, unfortunately, again, across the board in most situations, you can't really get coverage if a child has been diagnosed with autism. Generally, what will happen is the underwriter will say we'll relook at it at age 16 or 18. So again, that's a really good opportunity to get children covered when they're young, because then you don't have to worry about that, because we see it all the time. I probably get that question on a weekly basis, and it's really, really sad because we can't provide coverage. And I don't even think that there's an insurance company at this point that would offer coverage for that specific scenario. Right.
Okay, great. Jesus, that's was there something else that came with it? I think that's about it. So we're 3 minutes ahead of schedule, which is great. So obviously, if anybody has any questions, feel free to reach out to your team here, or of course, reach out. Feel free to reach out to Lisa as well and her team. But yeah, thanks for coming, and thanks everybody for sticking around. And this is a great hot day here in Ontario, so at least we're all in AC and we're staying cool. So we got to hear some cool presentations as well. So thank you, Lisa. Thank you, everybody, and we'll see you guys next time.
Thanks so much for having me, Dave. I appreciate it.
All right, you take care.